Well, meanwhile, Treasury Secretary Janet Yellen was pressed on the United States' ability to afford two wars on two fronts. Take a listen.
America can certainly afford to stand with Israel and to support Israel's military needs. And we also can and must support Ukraine in its struggle against Russia. And look, the American economy is doing extremely well.
Let's get reaction now from Kingsview Asset Management CIO Scott Martin and Capitalist Pig Hedge Fund Manager Jonathan Hoenig. Gentlemen, great to see our Chicago boys are here. I want to go to Jonathan first and just ask, Biden came into office declaring himself to be an enemy of this concept of endless wars. Now he's on two completely separate fronts, one in Europe and one in the Middle East. How can that not increase inflation with all the extra spending the United States is going to be doing?
Yeah, I mean, David, whether or not you believe we should be involved in these wars, we're certainly going to spend a hell of a lot of money. And keep in mind, we're already spending a lot particularly on debt service. I mean, we're spending more on servicing the debt now than we are on national defense, as it is, $2 billion a day. And with all due respect to Janet Yellen, keep in mind, Janet Yellen said that inflation would be transitory. Meanwhile, you've got 60% of Americans living paycheck to paycheck and 401k withdrawals at an all-time high. So the more we spend, David, the slower economic growth, the more innovation, and the slower the economy grows.
All right. Well, Scott, you're not old enough. I am. I remember the guns and butter policy of LBJ back in the late 1960s. That led to a huge increase in the late 60s, early 70s, throughout the 1970s of inflation. We didn't kill it for a full decade until Ronald Reagan came in and Paul Volcker, of course, at the Fed. Guns and butter seems to be exactly the policy that this administration is following.
True, and that might be what Joe Biden suggests we use in war is butter after the mistaken policies that he's had over the years. And I'll tell you what, I'm more of an old enough ilk here, David and Jonathan, to remember Milton Friedman, my monetary phenomenon boy, which is inflation, which talks about how money supply and things that are basically expended into the economy, if that's even a word, do create higher prices. And so this is money that doesn't necessarily go there. It doesn't necessarily increase the velocity of money, but still can be inflationary and can affect the price of the dollar. David, I'm not sure if Janet Yellen is still feeling the effects of, say, the Chinese psychedelics that she took a few weeks ago, because talking about how strong the economy is and talking about, like Jonathan said, about the folks living paycheck to paycheck, the massive amount of debts over there on the personal side, not let alone the public side, show that the economy is not that greatly strong. And it's certainly not an economy that we should just start throwing money around the world to try to fix all these problems that other countries have. So we need to focus on a lot of policies here at home, fix the immigration crisis that we have going on here, the border crisis, of course, the crime rates that are accelerating here in Chicago and around the country, and make businesses able to start to produce and redo what they've done in the past, which is fulfill and propensity to have the economic growth go forward because of the fact we have a focus on the private sector, not the public one.
Jonathan, meanwhile, you look at the bottom right of your screen, you see a market increase on the Dow of about 350 points right now. NASDAQ is up as well, even though interest rates continue to rise. I assume that what investors are focusing on right now is, one, the fact that perhaps we did skip a recession, and two, the fact that consumers, despite the fact that they're up to their neck, up to their eyeballs really in debt, they're still spending.
Yeah, David, credit card debt at an all-time high, credit card debt interest rates at an all-time high. And look, I'm happy to see the market bouncing today, but keep in mind, a majority of stocks are still below both their short-term and their long-term moving averages. So the trend for most stocks is down. And David, you're right. The inflation that we experienced in the 1970s, it started really with that spending in the late 1960s. And, we thought under Gerald Ford in the mid-1970s that inflation was under control, was going to be a soft landing. Yeah. Meanwhile, it was 7 more years and needed austerity, not just under Carter, but under Reagan as well, to ultimately get inflation interest rates under control. So Yellen and Biden might kind of paint a happy picture. The market's up, but everyday Americans are struggling, and inflation simply isn't going away yet.
Well, Scott, it's a big week for the Fed. It's a big week for earnings as well, we should mention, but the Fed is going to come to some kind of decision. What do you think is going to happen there?
Nothing, to summarize a word, but I'm yelling and screaming for the Fed to get with the program here, which is that, as Jonathan said, I mean, and you said too, David, rates are already behaving in respect and maybe in advance of what the Fed has talked about and what they're projected to do. So some of the Fed governors have talked over the last, say, a couple weeks, and one of the recent weeks was talking about how, well, the open market interest rate, so look and say the 10-year note, is already doing the work of the Fed and maybe the future work of the Fed.
Right.
So my big thing is Fed's got to take a chill pill and sit back and let rates determine it, and they need to kind of be quiet and step back here.
Well, it's good to see the market do the work rather than the Fed. A lot of people think the market has more wisdom than a few folks at the Federal Reserve Board. We got to leave it at that, gentlemen. We want to go to the region itself.